We move on to the second topic we've chosen, big trouble in US private equity market. Big trouble in US private credit market. Now, the US private credit market is facing the greatest stress since the 2007-2008 financial crisis. It has had years of rapid growth. Just a few headlines for everyone before we dive in and explain what's going on. It's Kunal Shah, who is a Gujarati by origin, very clever chap. He's the co-chief executive of Goldman Sachs, and he's the global co-head of fixed income currencies and commodities. Now, he said, and this has come out in numerous publications, it was first reported by the Financial Times, a venerable publication from London, now owned by the Japanese, that some of Goldman's clients were just glad there's something to talk about that isn't software exposures and private credit. And of course, they were glad about the Iran war. And this is really, if this does not send warning bells ringing loudly in people's ears, I don't know what should. Let's look at some facts, recent headlines. Blackstone Private Credit, which is a marquee name, reported first monthly loss since 2022. Ares Management has limited withdrawals from one of its marquee private credit funds pitched to wealthy individuals. Redemptions surged to 11.6% in the first quarter amid a broad flight from the asset class. Apollo Global Management, another huge name, has limited redemptions from one of its flagship private credit vehicles, becoming the latest investment manager seeking to staunch outflows as wealthy investors retreat from the industry. Why are investors ditching private credit funds? Well, because there are rising worries over bad loans. Publicly traded vehicles are trading at steep discounts, in a gloomy sign for broader industry. Last month, Blue Owl permanently, another fund and a well-known one, permanently restricted investors from withdrawing their cash from its inaugural private retail debt fund. Investors will no longer be able to redeem their investments in quarterly intervals voluntarily. And I must apologize for tooting our horn, but in September 2025, when there were bankruptcies, twin bankruptcies in Tricolor Holdings and First Brands Group, which shook private credit market, and there were fraud allegations that shook investor confidence, we pointed out in our FOI Geopolitical Risk Monitor, and this is what Sanjay Acharya and Manu Sharma worked very hard on, was that this was a massive risk. And so before we carry on, let me quickly explain what are private credit markets, because a lot of people don't know about them. Well, private credit markets, they basically make loans to companies, or rather they are non-bank lenders who make loans to companies. So if you go to a bank such as JP Morgan or Goldman Sachs, you either get a loan and there are a lot of conditions, maybe you have to attach a security, or you issue bonds on the public market. Private credit involves just private investment firms lending money directly to businesses. Now, of course, they charge higher interest rates. It's a risk reward thing going on. So who are the key players? Well, the lenders, the borrowers, and the investors. So who are the lenders? Typically private equity firms, hedge funds, or specialized business development companies. Who are the borrowers? Mostly mid-sized companies that might be too small for the public bond market or too risky for traditional banks due to strict post-2008 banking regulations. There was a big Dodd-Frank Act after the 2007-2008 financial crisis, and that has, some would say, quite onerous regulations. So people just go directly to the lenders. Who are the investors? They are large institutional players like pension funds, So it could be firefighters whose pension funds are going through an indirect route to these companies, insurance companies, sovereign wealth funds, often from the Gulf, who provide capital to private credit firms. And why do they do so? Because for a long period, we had loose monetary policy, low interest rates, and all these funds are chasing returns. And because they were chasing returns, there was too much capital chasing too few returns. They ended up making riskier and riskier bets. The covenants which borrowers, restraining borrowers or demanding disclosure from borrowers or other conditions of borrowers declined. Anyway, so these are the key players. And I'm telling you, number two, or the second part, why do companies use it? Because, of course, for the investors, they are chasing returns. For the borrowers, it helps them get around regulations. For the lenders, again, they think they are completely fixated on returns, both to themselves and to their limited partners. General partners are those who manage the fund. Limited partners are those who invest in the fund. And basically, there are advantages to private credit. Speed, certainty, you can close a deal more quickly than if you negotiate with a traditional bank loan. There's obviously flexibility. There's confidentiality, which is a big deal. So you don't have to disclose much to the general public. That's why companies like it. Why investors like it, I've already told you. Higher returns, there are floating rates. So if central banks raise rates, then you can raise rates. And because these loans are illiquid, you get higher returns. But as with everything, there are risks. When the economy turns, you're locked in. Mid-sized companies are also more vulnerable to economic downturns. So you have credit risk. There's also lack of transparency. So confidentiality may be good for the company. It's not so good for investors. It is not so good if your pension has been invested here and you don't know anything about it. And now the private credit market is a $2 trillion powerhouse. It is facing its first significant cycle of stress, higher interest rates, economic shifts, and of course, AI is upending business models of many of these software companies, medium-sized software companies. Our sources in finance think that private credit markets suffer from significant liquidity and valuation. Of course, some are more bullish than others. Some think it's just $2 trillion. In the larger scheme of things, it is not so much. They will, the economy will ride out the downturn. Some others, however, think that just as the subprime crisis of 2007, 2008 was dangerous, the downturn valuations of private credit funds could be much higher, on paper than in reality. So they could be valued on paper much higher, and therefore people are trying to get their money out. And none other than Jamie Dimon of JP Morgan has talked about if you see a cockroach, the cockroach theory. It means that if you see one cockroach, there's a likelihood there are many others. And so one piece of bad news or a few pieces of bad news imply more hidden problems. Some argue that
my father had a much better way to describe that than Jamie Dimon. My father said that if the father finds his daughter with the stable boy in the hay in the barn, you can't believe that that's the only time that they've been together.
That is certainly more memorable. Going back to private credit, many think that, and we think that, and we've said so from September, that private credit represents systemic weakness in the American financial system. Banks have withdrawn from riskier markets. New institutions have replaced them in this era of cheap liquidity. Basically, these institutions have lent in opaque markets, so no one really knows what's going on. This has led to complex arrangements out of sight of regulators or even the institutions involved. And so what we see, this increase in payment in kind usage, that is a danger sign. And it is not just us. Mohammed Al-Arian, who is the former CEO of Pimpo, in a very sharp chat, he has called, earlier this year, he said, is this a canary in the coal mine moment, similar to August 2007, quote unquote. And so some of the most reputed investors are sounding the alarm, and they think, of course, some people think financial markets will shrug this all off, but some others think that this may not be the case. Importantly, and because we are running out of time, there are two nuggets of information that are pertinent here. Our sources in law firms are worried because they think that years of low interest rates, ultra low yields, and very few bankruptcies lowered the risk premium for a lot of lending. Furthermore, covenants that allow lenders to intervene when financials of borrowers have weakened over the years. This means that lenders have fewer tools to fix a problem before default. And our sources in the US Treasury and the Federal Reserve, especially the Federal Reserve, admit and worry that systemic risk has increased. So this could lead to a credit crunch, and this credit crunch could lead to bankruptcies and job losses. And this is all happening at a time of a supply shock thanks to the Iran war. This is all happening at a time when US debt has crossed $39 trillion. And this has all happened when 2-year treasuries have been hard to sell on the open market. Over to you, Glenn, now that I have played Cassandra. Yet again.
Just to try to summarize, I'd say that Atul and I have been for quite some time, certainly I have, but I think both of us, quite some time, structural bears, not just with regard to the market, which is sort of waves on the surface in many ways of deeper economic truths, but of the economies as a whole. The Gregory Mankiw, President Bush, the son's chairman of the Council of Economic Advisors, has for years been crying wolf about the growing, almost unsolvable, certainly unsolvable for political reasons, structural debt problem of America's federal deficit and debt, which affects interest rates, which will affect the availability of cash, which will affect the GNP and employment rate. Everything Atul has talked about are both evidences of that and contributing data points, making the same broad point. Paul Krugman, who is equally well regarded as Gregory Mankiw on the center left, is Mankiw on the center right, has been saying making similar points and alarms for years. Warren Buffett, who's a man who only pays attention to fundamentals, has taken his money out of the stock market years ago. The stock market, at a more superficial level but relevant, has been growing unhindered for 15 years or 18 years now. And there's only one direction things can go when you're at the summit. The policies of the White House in the last 2 years, and for now 6 of the last 10, have been like a strong current washing the sands under the foundations of the American economy away. Almost every structural basis of a strong economy are being eroded by the decisions taken in the White House, with the exception of the one thing on which traditional Republicans obsess, which is deregulation, which does lead to faster growth. That is true. It has other consequences too. So all of this adds up, as Atul detailed for us all, to we would argue, pretty vividly flashing warning signs about a structural downturn of a lasting nature for the global economy. And that's not what the standard experts are predicting, because they do say, the data is contradictory.
Yes, and they have an incentive to say so, especially if they are in the business of selling funds and asking you to invest in their funds. But we take the view that you cannot ignore structural weaknesses and foundational flaws forever. At some point, the structure cracks.
So,
all right.
Put your money in your mattress.
or buy gold or platinum or silver or commodities like gas. Anyway, thank you very much. If you're watching this on YouTube, make sure you subscribe to our YouTube channel. Make sure you press the bell icon to get updates. Make sure you sign up for our newsletter on our website. We make sure that we give you honest, rigorous analysis. We may be wrong, but we try our best. And we will see you now in April. Until then, bye for now.
See you later.
Join the conversation at Fair Observer and subscribe to our YouTube channel.